Welcome to the free Candlestick Patterns course. Before we begin the course, let me give you a brief introduction and overview of what you're going to learn in this video. In this free course, you are going to learn the most relevant and most frequently used candlestick patterns. We'll begin by looking at the elements of a candle pattern and how we use these different elements to classify the various patterns in useful ways. Next, we'll look at each candle pattern individually. We'll look at the name and classification of each pattern, the logical interpretation of each pattern, which is extremely important, the comparison and connection between different types of patterns, which is something that helps memorizing not only the name, but the logical interpretations as well, the advantages and disadvantages of using candlestick patterns as a trading technique, and some very important conclusions about the use of this technique in real trading. This is considered to be basic knowledge about trading, so this entire course is free. Let's begin by talking about the basic elements of candlestick patterns. A candlestick pattern has two elements that classify it: the complexity and the type. It's important to understand these elements and classifications because that will simplify things later. Let's take a look at each of these two elements individually to see what they mean. The complexity of a candlestick pattern refers to how many candlesticks compose the pattern. There are two levels of complexity. There are simple patterns and complex patterns. Let's see what these two classifications mean. A pattern can be simple, which is when the pattern is formed by only one candlestick. In other words, the shape of only one candlestick will give a signal about what the market is going to do next. A pattern can also be complex, which is when the pattern is formed by two or more candlesticks. In other words, a combination of two or more candle shapes will form a single pattern that will signal what the market is going to do next. All candlestick patterns we are going to study in this course can be categorized into these two levels of complexity. In other words, candlestick patterns can be simple, which is when the pattern is formed by one candlestick only, or they can be complex, which is when the pattern is formed by two or more candlesticks together. That sums up the first element of a candlestick pattern, which is its complexity. Let's take a look now at the second element, which is the type. There are three types of patterns: the reversal patterns, the continuation patterns, and the neutral patterns. Let's begin by taking an overall look at reversal patterns. Reversal patterns indicate that price will reverse its current direction, meaning that price will be going in one direction, and when the pattern appears, it will start going in the opposite direction immediately after. Reversal patterns can be bullish or bearish, so let's take a quick look at what that means. The terms bullish and bearish are part of the market jargon to indicate if something is going up or down. Just as a curiosity, when traders say bullish, they want to indicate upside because bulls throw their prey up when they attack. When traders say bearish, they want to indicate downside because bears throw their prey down when they attack. Let's examine the bullish reversal pattern first. In a bullish reversal pattern, it means that price will be going down, then a specific pattern will appear to signal a reversal to the upside. In other words, the bullish reversal pattern signals that price will go up immediately after the pattern. Conversely, in a bearish reversal pattern, it means that price will be going up, then a specific pattern will appear to signal a reversal to the downside. Some people get confused by this, but all you need to remember is that the term bullish or bearish indicates the direction price will go after the pattern. So a bullish reversal pattern signals that price will go up, and a bearish reversal pattern signals that price will go down. In summary, reversal patterns indicate that price will reverse its current direction, and they can be divided into bullish and bearish reversal patterns. Next, we are going to take a look at continuation patterns. Continuation patterns indicate that price will continue to go in its current direction. Like the name suggests, the continuation pattern states that price will continue its current trajectory instead of reversing it. Like reversal patterns, continuation patterns can be bullish or bearish. In a bullish continuation pattern, it means that price will be going up, and then a specific pattern will appear to signal that price will continue to go up instead of reversing to the downside. The term bullish indicates the direction price will go immediately after the pattern. In a bearish continuation pattern, it means that price will be going down, and then a specific pattern will appear to signal that price will continue to go down instead of reversing to the upside. Once again, the term bearish indicates the direction price will go immediately after the pattern. That covers the continuation patterns. In summary, the reversal patterns indicate price will change direction, and continuation patterns indicate that price will not change direction. Both reversal and continuation patterns can either be bullish or bearish. The third and last type of candlestick pattern is the neutral pattern. Neutral patterns indicate a momentary stop in price. Unlike reversal and continuation types, there is no such thing as bullish or bearish neutral patterns. In a neutral pattern, price can either be going up or down, and then a specific candlestick pattern will appear to signal that price stopped advancing in its current direction. For example, imagine that price was going up. If a neutral pattern appears, it will indicate that price has momentarily stopped going up, but it doesn't necessarily mean it will continue going up or reverse to the downside. In other words, the neutral pattern doesn't indicate the direction that price will go next. It just indicates that price has momentarily stopped advancing its current direction. That concludes the overview of the three types of candlestick patterns. In summary, reversal patterns indicate that price will change direction, and continuation patterns indicate that price will continue its current direction. Both reversal and continuation patterns can either be bullish or bearish. Neutral patterns don't indicate the future direction of price. They simply indicate a momentary stop. Since neutral patterns don't indicate the future direction of price, there is no such thing as bullish or bearish neutral patterns. That covers the two elements of a candlestick pattern. The combination of these two elements form the classification of candlestick patterns, which is very useful to organize the many patterns we want to memorize and understand. The way we use the classification is by saying the complexity first and then the specific type to classify the pattern. For example, a simple bullish reversal pattern. Just by looking at the classification, we know that the pattern is composed by only one candlestick since it's a simple pattern, and we also know that the pattern indicates a reversal to the upside since its type is bullish reversal. Another example could be a complex bearish continuation pattern. Again, just by looking at the classification, we know that the pattern is composed by two or more candlesticks, and that it indicates that price will continue to go down since it's a bearish continuation. A third example could be a simple neutral pattern. In this case, we know that the pattern has only one candle and that it indicates a momentary stop in price. The way we study various candlestick patterns is by saying their name and then saying their classification. For example, the hammer is a simple bullish reversal pattern. In this case, the name of the pattern is hammer, and just by looking at its classification, we know that it is composed by one candlestick only, and it indicates that price will go up immediately after the pattern appears. Another example could be the doji is a simple neutral pattern. So the name of the pattern is doji, and by looking at its classification, we know that it is composed by one candle only, and it indicates a momentary stop in the advancement of price. As I said before, this is useful to memorize and organize the patterns since there are many of them. Now that we understand the details of how we classify the various candlestick patterns, we can start studying the patterns individually to learn about their logical interpretations, which is the most important part. Before we move on, there is one last thing to remember. Names and classifications just help memorizing and organizing the patterns. The really important thing is to understand the logic behind each candlestick pattern. You will not benefit from learning all the patterns if you don't understand why they might work and the rationale behind each one. With that said, let's begin by taking a deeper look into the neutral candlestick patterns. There are only simple neutral candlestick patterns, meaning patterns formed by one candlestick alone. The neutral patterns are formed by the doji family, which is itself formed by 5 types of doji. The main characteristic of a doji is that the opening and closing values of a candlestick are equal to one another. In other words, dojis have no candle body. That's the key to understand why dojis are a neutral pattern. The fact that the open and close values are equal to one another implies that there was no clear winner in the internal battle of buyers and sellers of the candlestick. During the formation of the candle, buyers and sellers struggle to see who is going to dominate that candlestick in particular. If the candlestick closes higher than it opened, it generally means that buyers won that battle. If the candlestick closes lower than it opened, it generally means that the sellers won that battle. If the open and close values are exactly the same, it means that neither buyers nor sellers won because they have similar power. And if they have similar power, price has no specific bias or direction. That's why a doji is mainly a neutral candlestick pattern. Even though the main characteristic of dojis is simple, there are 5 different variations of dojis. We have the doji star, the long-legged doji, the gravestone doji, the butterfly doji, and the 4-price doji. Even though dojis are neutral patterns, these different variations of dojis imply different things about buyers and sellers. The doji star received this name because its shape vaguely resembles the silhouette of a star, which makes it easier to remember the candlestick shape. The main characteristic is that the open and close values are equal to one another, otherwise it wouldn't be a doji. The other important characteristic here is that there are small upper and lower tails, and they have equal size. The fact that the upper and lower tails are small implies that there was a battle between buyers and sellers during the formation of the candlestick, but this battle wasn't so violent, and that resulted in a candlestick with relatively low volatility. The fact that the upper and lower tails of the candlestick are equal to one another implies that at some point during the internal history of the candlestick, buyers were winning the battle, and in another point, sellers were winning the battle. But both buyers and sellers temporarily won that battle with the same intensity. You can think of the candlestick tails as the marks of this battle. That means that the doji star is a completely neutral pattern. The long-legged doji is exactly the same as a doji star, with one exception, which is the size of the upper and lower tails. This difference in the length of the upper and lower tails implied that the battle between buyers and sellers was more heated than in a doji star, for example. Even though the battle was more violent, the upper and lower tails are still equal in length, and that means that buyers and sellers still have the same power, so the long-legged doji is a completely neutral pattern. The only difference is that it's a more volatile pattern than the doji star, meaning that the internal battle between buyers and sellers was more heated. The gravestone doji is where things start to become a little trickier because the upper and lower tails are asymmetrical. For instance, in the gravestone doji, the upper tail is large and the lower tail is non-existent. That means that during the internal history of this candlestick, buyers were once up there in the high of the candlestick. However, in order for the candlestick to close in the same price as the open and become a doji, sellers had to win that battle at the top of the candlestick and bring the price down. Despite the asymmetry in the candlestick tails, the pattern still implies a neutral bias because the open and close values are equal to one another. The butterfly doji is the mirror image of the gravestone doji. We can see that at some point during the internal history of the candlestick, sellers were winning the battle near the low, but buyers had to overcome the sellers to make the candlestick close in its opening value. The last type of doji is the 4-price doji. The name comes from the fact that all the 4 prices in a candlestick, meaning the open, the high, the low, and the close values, are all equal to one another. Thinking in terms of the interpretation of this pattern, there is no battle between buyers and sellers, as we can infer by the absence of upper and lower tails. Notice that there are 2 things that we pay attention to in dojis: the symmetry between upper and lower tails and their size. Next, we are going to look at simple reversal patterns, both bullish and bearish. The first pattern we are going to study is the hammer, which is a simple bullish reversal pattern. In other words, when price is going down and a hammer appears, That's a signal the price will reverse its direction to the upside. The shape of a hammer has a few characteristics that make it a bullish reversal pattern. The first thing to notice is that the hammer received its name because the candlestick resembles the shape of a hammer. This pattern is also composed of a small bullish candle body that lives on the upper range of the candlestick. Hammers can have a small upper tail, but one of its main characteristics is that it has a large lower tail. The logic behind a hammer is quite simple. We need to roll back the internal history of the candlestick to understand why it means a bullish reversal. Notice that the hammer opens on its upper range, creates a large lower tail, and then it closes on the extreme of the upper range with a small bullish body. That basically means that sellers had the control in the beginning of the formation of the hammer, and that's why price was down there at some point. However, once buyers realized that the sellers were gaining control, they appeared to assume control again, so they make price close on the upper extreme of the candle range. The large lower tail signifies the fact that sellers had the control, but buyers were able to overcome that. If buyers are able to do that, it means there is more buying pressure than selling pressure on the candlestick. The way a hammer generally appears in a price chart is when the price is going down, then a hammer appears, and immediately after, price begins going up. One thing to remember here is that not all hammers work. In other words, sometimes a hammer will appear and price will continue its main direction without reversing as the pattern suggests. There is an important lesson here that hammers, like any other candlestick pattern, are just one sign about what the market might do in the future. They are not definitive signals. Another point of confusion that is relevant not only to hammers, but to all candlestick patterns is the fact that the shape of the candlestick can vary a lot and still be classified in the same way. For instance, a hammer might have a slightly larger candle body or a small upper tail and still be classified as a hammer. The point is that these candle patterns don't have a rigid shape. They have an overall shape that is malleable and can be subjected to some changes. The next pattern we are going to see is the inverted hammer, which is a simple bullish reversal pattern. The inverted hammer is very similar to the hammer, but it has one major difference. The candle body lives in the lower range of the candlestick, so naturally there is a large upper tail instead of a large lower tail. The inverted hammer is still a bullish reversal pattern because the candle body is bullish, but it's a weaker pattern relative to the hammer. To understand that, we need to roll back the internal history of the candlestick. The fact that the inverted hammer has a small bullish body and a large upper tail implies that at some point during the formation of the candlestick, buyers were really strong. However, sellers were able to overcome that and bring the closing of the candlestick to its lower range. Even though sellers prevented buyers from closing the candle on its upper range, buyers still managed to win the battle in the lower range by creating a bullish body. Given that context, we can see that even though buyers won the battle in the end, they are not as strong as they are in a normal hammer pattern. The way an inverted hammer appears in a price chart is when price is going down, then an inverted hammer appears, and then price will tend to go in the opposite direction right afterwards. The next pattern is the shooting star, which is a simple bearish reversal pattern. The shooting star has a very similar shape to the inverted hammer pattern, but there are two fundamental differences. The first is that a shooting star is a bearish reversal pattern, while the inverted hammer is a bullish reversal. That means that a shooting star appears when the price is going up to signal a reversal to the downside. The second difference is that a shooting star has a bearish body, while the inverted hammer has a bullish body. The shooting star pattern is formed by a candlestick with a small bearish body that sits in the lower range of the candlestick and a long upper tail. It received this name because it resembles the silhouette of a shooting star, so that's one way of memorizing the pattern. The logical interpretation of why this is a bearish reversal pattern is that, since it appears when price is going up, the long upper tail implies that buyers were once dominating the candlestick, but sellers were strong enough to bring price down and make the candlestick close with a small bearish body in the lower range. All of that implies more selling pressure than buying pressure. When that happens while price is rising, we have a signal that the trend might reverse to the downside. The way a shooting star works is that price will be going up, and then after the shooting star appears, it will start to go down. Let's remember once again that this is just a signal. There's absolutely nothing that stops price from continuing going up after a shooting star pattern, just like with any other pattern. The next pattern we are going to study is the hanging man, which is a simple bearish reversal pattern. The hanging man has a very similar shape to the hammer, but the main two differences is that the hanging man appears when price is going up and it has a bearish body. The hanging man is also the shooting star pattern upside down, just like the inverted hammer is the hammer pattern upside down. The hanging man has a small bearish body that sits on the upper range of the candlestick and a long lower tail. The hanging man still implies more selling pressure because sellers are able to make the candlestick close with a small bearish body. However, notice that even though sellers win the final battle, they don't do that by a large margin, since the hanging man has a long lower tail that implies buying pressure too. The best way of looking at this is that the hanging man represents that sellers have slightly more power than buyers, unlike in a shooting star, for example, where the selling pressure is much larger than the buying pressure. The way a hanging man will appear on the chart is that price will be going up, and then a hanging man will appear to signal a reversal to the downside. The hanging man closes the list of simple reversal patterns. So let's review a few things about how the four of them correlate with each other. There are many details that connect these four patterns in different ways. The first thing we can notice right from the start is that their shapes are very similar. What varies regarding their shapes is the position of the candle body in relation to the candle range, which consequently affects the size of the upper and lower tails. The other detail that is less self-evident in here is that the context in which these patterns occur dramatically change their interpretations, even though they have similar shapes. For instance, the hammer is very similar to the hanging man. The only difference is that one has a bullish body and the other has a bearish body. However, the fact that the hammer appears in a down move means it will signal a possible reversal to the upside, while the hanging man appearing in an upper move means a possible reversal to the downside. Notice that the quality of the candle body dramatically changes the logical interpretation of the candlestick pattern. One good way of thinking about these patterns is that the candle body tells you who won the battle in that candlestick, and the tail tells you the places where that battle took place. And based on that, we can infer buying power or selling power. Let's move on now to the complex reversal patterns, where we have two or more candlesticks forming a pattern that will indicate a reversal in the current direction of price. We'll start with the complex patterns that have two candles, and then we'll move on to the more complex patterns later. The first complex reversal pattern we are going to study is the bullish engulfing pattern. The bullish engulfing pattern is formed by two candles, where the first candle is a small bearish candle, and the second is a medium to large bullish candle that completely engulfs the range of the first candle. The main characteristic of this pattern is precisely the fact that the second candle completely covers or engulfs the range of the previous candle. The logical interpretation of this pattern is that buyers are powerful enough to create a candle that covers the entire range of a previous bearish candle. Notice that sometimes the second candle will open with a small gap down, denoting selling power. But even with that, buyers will have enough strength to reverse that condition and create a bullish candle large enough to engulf the action of the previous candle. That is an explicit display of buying pressure, so it's a strong indication about the force of buyers and the weakness of sellers. A bullish engulfing pattern appears when price is going down, and then a bullish candle large enough to engulf the previous bearish candle appears, therefore signaling a reversal to the upside. Notice that this pattern necessarily needs two candles because the whole pattern is based on the fact that the second candle engulfs the first one. The next complex reversal pattern is the bearish engulfing, which is precisely the opposite of the bullish engulfing. The logical interpretation of the two patterns is exactly the same, but the bearish engulfing denotes a reversal to the downside. The first candle will be relatively small and bullish, and the second candle will be a medium-sized or large bearish candle to the degree that it completely engulfs the first candle. In other words, in a bearish engulfing pattern, the sellers will explicitly display dominance over buyers. The bearish engulfing pattern will appear when the price is going up, and then a large bearish candle will form to completely engulf a previous small bullish candle, therefore signaling a reversal to the downside. It should be clear to you that the second candle is a very clear indication of dominance. It's useful to associate opposing patterns together. In the case of the bullish engulfing and the bearish engulfing, that's not a problem because the names of the patterns clearly indicate what they mean. However, that's not always the case, as we'll see in the next two patterns. The next complex reversal pattern we are going to study is called the piercing line, which is a bullish reversal pattern formed by two candles. This is a subtler pattern than the engulfing patterns we just studied because it involves the perception of a gap between the close of the first candle and the open of the second candle. In a piercing line, the first candle is a bearish candle, and the second candle is a bullish candle that opens with a gap down. We have to be careful here because a gap down denotes selling power. However, the buying power in the second candle overcomes the selling power that creates the gap down. Beyond that, and this is why the pattern receives its name, the second candle is able to pierce the line created by the closing of the first candle, hence the name piercing line. This is a bullish reversal pattern because buyers are able to fill the gap between the two candles, and they are also capable of piercing the line created by the closing value of the first candle. The reason we care about this line created by the closing value of the first candle is because it represents the price where sellers won the battle in the first candle, so it's an important level. When buyers are able to close the gap and pierce or violate that line, we have an indication that buying power is greater than selling power. The piercing line appears when the price is going down in order to signal a reversal to the upside. The next pattern is the precise opposite of the piercing line, and it's called the dark cloud. In other words, a complex bearish reversal pattern composed by two candles. The second candle opens with a gap up, implying some buying power, but the second candle closes with a significant bearish quality that not only closes the gap created by buyers, but also pierces the line created by the closing value of the first candle. Even though the name dark cloud has nothing to do with piercing line, the two patterns are mirror images of each other. The name dark cloud comes from the analogy that the second bearish candle covers the first candle in part, just like a dark cloud sometimes covers the sun. It's an analogy that makes it easier to remember the pattern. The dark cloud will appear when price is going up to signal a reversal to the downside. The next two complex reversal patterns we are going to study are similar to the piercing line and the dark cloud, but they are slightly weaker signals in a way. The first pattern is called bullish meeting line, which is similar to the piercing line since it's a bullish reversal pattern, but it's a weaker signal. The bullish meeting line also displays a gap down between the first and second candles, but unlike the piercing line, in the bullish meeting line there is no violation of the line that represents the closing value of the first candle. The logical interpretation here is that buyers are strong enough to fill the gap created by sellers, but they are not strong enough to violate or pierce the closing line of the first candle. In other words, the closing line of the second candle meets the closing line of the first candle, hence the name of this pattern. The bullish meeting line appears when price is going down in order to signal a reversal to the upside. We also have the bearish meeting line, which is the mirror image of the bullish meeting line. The bearish meeting line is the slightly weaker version of the dark cloud because, even though sellers are able to fill the gap created by buyers, they are not strong enough to pierce or violate the closing line of the first candle. Nonetheless, the bearish meeting line still represents a bearish reversal pattern. The bearish meeting line appears when price is going up in order to signal a reversal to the downside. Next, we are going to study 4 different patterns that have one thing in common, which is something called the harami position. The first pattern we are going to study is called the bullish harami. The word harami in Japanese is associated with the word pregnant. This pattern received this name because the second candle in the pattern is fully contained in the range of the first candle. This is an analogy to a baby contained inside a pregnant woman. The analogy also works in the sense that the harami means the birth of a new trend. In a bullish harami, the first candle is bearish and the second candle is bullish, and fully contained within the range of the first candle. In this case, the small bullish candle represents the new uptrend that is about to be born. There can be a small gap up between the two candles, which helps confirm this bullish signal. The logical interpretation of this pattern is that a small bullish body fully contained within a wider bearish candle means that sellers stopped advancing price to the downside and a small bullish pressure began to appear. The bullish harami appears when price is going down in order to signal a reversal to the upside. Next we have the bearish harami, which is a mirror image of the bullish harami. The bearish harami indicates that buyers have stopped advancing price to the upside, and the small bearish candle fully contained within the range of the first bullish candle, opening with a small gap down, implies the birth of a new downward trend. The bearish harami appears when price is going up in order to signal a reversal to the downside. Next in line we have a second type of harami pattern called bullish harami cross. This is exactly like a bullish harami, but the second candle in the pattern is a doji cross. In terms of logical interpretation, the bullish harami cross is a slightly weaker signal than the bullish harami because the second candle doesn't display a bullish body. With that said, in the bullish harami cross, sellers still stop to advance price to the downside, and the doji cross opens with a small gap up to indicate bullish pressure. The bullish harami cross appears when price is going down in order to signal a reversal to the upside. The next pattern is the bearish harami cross, which is the mirror image of the bullish harami cross. In the bearish harami cross, the second candle opens with a small gap down and is fully contained in the range of the previous candle, which has a bullish quality. That indicates that buyers have stopped advancing price to the upside and there is a new potential downward move being born. The bearish harami cross appears when price is going up in order to signal a reversal to the downside. Next, we are going to study two reversal patterns that involve prominent gaps between the first and the second candlesticks. The first of these two patterns is called bullish kicking, which is a very straightforward pattern. The bullish kicking consists in a bearish candle followed by a bullish candle. The main characteristic of this pattern is that there is a prominent gap up between the two candles. The logical interpretation here is that a large gap up implies a high amount of buying pressure. The pattern receives this name because it is as if someone kicked the second candle up, hence the expression bullish kicking. The bullish kicking pattern appears when price is going down in order to signal a reversal to the upside. The other kicking pattern is the bearish kicking, which is the mirror image of the bullish kicking. In the bearish version, the first candle is bullish and the second candle is bearish. The two candles are separated by a prominent gap down that implies high selling pressure. In other words, the fact that the price opened with a large gap down implies that sellers have a lot more power than buyers. The bearish kicking pattern appears when the price is going up in order to signal a reversal to the downside. Now we'll move on to the last two complex reversal patterns that are formed by two candles. The first pattern is called bullish two soldiers, which is a bullish reversal pattern. The main characteristic of the bullish two soldiers is that the candles are isolated by one gap before and one gap after the pattern. The two soldiers in reference to the two candles that form the pattern are two bullish candles that have a small body. The logical interpretation of this pattern is that the two isolated bullish candles imply the beginning of an uptrend. In fact, whenever you hear the word soldier in the context of candlesticks, you can associate it with a bullish quality. The bullish two soldiers appear when price is going down in order to signal a reversal to the upside. Pay attention to the fact that both candles that form the pattern are isolated by one gap down before the first candle and one gap up after the second candle. The next pattern is called bearish two crows, which is the mirror image of the bullish two soldiers. The bearish two crows pattern is formed by two isolated and small bearish candles. They imply the beginning of a downward movement given the position of being isolated by one gap before and one gap after the pattern. The bearish two crows pattern appears when price is going up in order to signal a reversal to the downside. Pay close attention to the fact that there is one gap up before the first candle and one gap down after the second candle. Even though the pattern is theoretically formed by two candles, it's only with the candle after the two crows that we can make sure the two crows are in fact isolated by gaps on either side. Crows are usually associated with death, so the appearance of the bearish two crows represents the death of the uptrend, which implies the birth of the downtrend. Let's move on now to the complex reversal patterns that are formed by three candles. The first set of complex reversal patterns formed by three candles that we are going to study has four patterns associated with what's called the star position. Let's begin by looking at a pattern called morning star. The morning star is a bullish reversal pattern formed by three candles, where the first is a bearish candle, the second is a small bullish candle with very small or non-existent tails that opens up with a small gap down, and the third is a larger bullish candle that opens with a gap up. The star position is the position of the second candle. In other words, one small candle isolated by one gap on each side. Very much like other patterns we already studied, the small bullish candle isolated implies the beginning of a new uptrend, because even though the second candle opens up with a gap down, which implies selling pressure, the second candle is able to close with a bullish quality. The confirmation of this pattern comes in the third candle, which opens with a gap up and forms a larger bullish body. In other words, we have a double confirmation of buying pressure in the third candle. The morning star appears when price is going down in order to signal a reversal to the upside. The expression morning star refers to a star that rises, denoting the arrival of an uptrend after the pattern. The next pattern is called the evening star, which is the mirror image of the morning star pattern. In other words, it's a bearish reversal pattern. The first candlestick is bullish, the second candle in the pattern opens up with a gap up and it forms a small bearish candle, and the third candle is a larger bearish candle that opens with a gap down. Since the second candle opens with a gap up and it ends up forming a bearish candle, that implies buying pressure is losing to the selling pressure. The third candle gives a double confirmation of that by opening with a gap down and forming a bearish quality. The evening star appears when price is going up in order to signal a reversal to the downside. The expression evening star refers to a star that falls from the sky. It's a simplistic analogy that might help memorize the shape and meaning of the pattern. The next two patterns are very similar to the morning star and the evening star. The difference lies in the shape of the second candle in the pattern, meaning the candle that is in the star position. The first pattern is called morning doji star. The difference between the morning star and the morning doji star is that the second candle is a doji instead of a small bullish candle. In other words, the morning doji star is a slightly weaker signal than the morning star because a doji is a neutral pattern. However, the fact that the third candle in the pattern opens with a gap up and ends up being a larger bullish candle still makes the morning doji star a bullish reversal pattern. The morning doji star appears when price is going down in order to signal a reversal to the upside. Once you know what a morning star pattern looks like, it becomes intuitive to remember what the morning doji star looks like simply by recalling that the second candle in the pattern is a doji in the star position. The next pattern is the evening doji star, which is the mirror image of the morning doji star. Once again, we can see how these patterns are related. In the evening doji star, the second candle in the pattern is a doji in star position instead of a small bearish candle like in the evening star. That's the only difference. The doji candle is still isolated by one gap up and one gap down. Since a doji is a neutral pattern, the evening doji star is a slightly weaker signal than the evening star. The evening doji star appears when price is going up in order to signal a reversal to the downside. The next two complex reversal patterns containing three candles are related to the soldier and crow qualities I referred to previously. The first one is called three white soldiers, which is a bullish reversal pattern. The three white soldiers pattern begins with a gap down before the first candle, and then three small bullish candles appear in a row in ascending motion. The three bullish candles, or three white soldiers as they are called, fill the gap created before the first bullish candle, giving an indication that buying pressure is building up, so the market might go to the upside. The fact that the market displays three small bullish candles before the reversal implies that this pattern gives you some time to understand what's going on while the market is building buying pressure. The three white soldiers pattern appears when price is going to the downside in order to signal a reversal to the upside. Here we can see how the pattern begins with a gap down and then fills the gap with the three ascending candlesticks. Next we have the three black rows pattern, which is the mirror image of the three white soldiers and therefore a bearish reversal pattern. The three black rows pattern begins with a gap up and then three small bearish candles appear in order to build selling pressure to the downside and fill the gap. The fact that the market takes some time to fill the gap and build momentum to the downside implies there is more time for the trader to observe what's going to happen. The three black rows pattern appears when price is going up in order to signal a reversal to the downside. The next pattern we are going to study is called the three stars in the south, which is a bullish reversal pattern. This one is a little bit trickier because it's a bullish reversal pattern composed by three bearish candles. We have to pay attention to the decreasing size of candle bodies and the larger size of the lower tails in the candlesticks to apprehend the logical interpretation of this pattern. So the three stars in the south pattern has three descending bearish candles. Each candle has a smaller body than the previous candle. The other important detail is that the lower tails of these three candles are much more prominent than the upper tails. The logical interpretation of this pattern is that price is decelerating its downward momentum, hence the decreasing size of the candle bodies, and beyond that, price is encountering buying pressure as we can tell by the larger lower tails. You can almost see the sellers failing to create larger candle bodies and the buyers succeeding to create larger lower tails. Notice that sometimes the third candle in the pattern can be in a harami position, which is when the candle is fully contained in the range of the previous candle. This increases the strength of the three stars in the south pattern because the harami is also a reversal pattern. The three stars in the south pattern appears when price is going down in order to signal a reversal to the upside. Next we have the advanced block pattern, which is the mirror image of the three stars in the south, so it's a bearish reversal pattern. This pattern is a bit counterintuitive in the same way as the last one because it's a bearish reversal pattern formed only by bullish candlesticks. The pattern is formed by three candlesticks with decreasing body size and prominent upper tails. The progressive decrease in body size means that buyers are losing momentum, and the longer upper tails means that sellers are gaining momentum in relation to the buyers. Notice that, similarly to the three stars in the south pattern, the third candle can be in a harami position, which is when the candle is fully contained in the range of the previous candle. This increases the strength of the advanced block pattern because the harami is also a reversal pattern. The advanced block appears when price is going up in order to signal a reversal to the downside. The last two complex reversal patterns formed by three candles are the fry pan bottom and the dumpling top. The fry pan bottom is a bullish reversal pattern formed by two small bearish candles, followed by a small bullish candle that opens with a considerable gap up. The gist of this pattern is that the third candle jumps in the opposite direction of the previous two candles in an unexpected way. The logical interpretation here is quite simple, since a sudden change in movement with a gap denotes that the selling pressure has vanished away and the buying pressure is now dominant. The fry path bottom appears when price is going down in order to signal a reversal to the upside. Next we have the dumpling top, which is the mirror image of the fry path bottom. So it's a bearish reversal pattern composed by two small bullish candles followed by a small bearish candle that opens with a considerable gap down. The logical interpretation follows the same simplicity of the fry path bottom. A sudden change in direction aligned with a gap down means that buying pressure is vanishing away and that selling pressure is now dominant. What catches the attention of the fry path bottom and the dumpling top is that the third candle seems to hit an unexpected barrier to change direction. The dumpling top appears when price is going up in order to signal a reversal to the downside. This pattern finishes off the set of complex reversal patterns formed by 3 candles. Next we'll look at the final 4 complex reversal patterns that are formed by 5 candles. Notice that we jump from 3 candles to 5 candles because there are no relevant complex reversal patterns formed by 4 candles. The next pattern we are going to study is called the bullish breakaway, which is a bullish reversal pattern formed by 5 candles. 4 of them are bearish and 1 of them is bullish. The first candle in the pattern is a medium-sized to large bearish candle. The second candle opens up with a gap down and forms a small bearish candle. The next 2 candles are also small and bearish. The fifth candle in the pattern is what gives the pattern its name because it's a bullish candle that closes above the open value of the second candle in the pattern. That's important because it violates the gap created by the sellers along with the previous 3 candles. The logical interpretation here is that selling pressure is exhausted in the 3 middle candles of the pattern and buying pressure begins to appear in the 5th candle. The bullish breakaway appears when price is going down in order to signal a reversal to the upside. The next pattern is the bearish breakaway, which is the mirror image of the bullish breakaway. So it's a bearish reversal pattern formed by 4 bullish candles and 1 bearish candle. Following the opposite rationale of the bullish breakaway, in the bearish breakaway, buying pressure slowly exhausts itself in the middle 3 candles of the pattern after the gap up, and the selling pressure suddenly appears violating the gap up. The bearish breakaway appears when price is going up in order to signal a reversal to the downside. The next pattern we are going to analyze is called tower bottom, which is a bullish reversal pattern. The first 2 candles in the pattern are bearish, 1 medium-sized candle followed by a small candle. That already denotes a decrease in selling pressure given the decrease in the body size of the second bearish candle. The third candle in the pattern is a small bullish candle that opens with a gap up. That means a sudden burst of buying pressure. The fourth candle in the pattern is equal to the second candle in the pattern, and it opens with a small gap down. The important thing here is that a sudden burst of buying pressure appeared, and then the sellers tried to overcome that but failed to do so because the fourth candlestick in the pattern fails to advance price to the downside any more than the second candle did. The last candle hits the final nail in the coffin, so to speak, because it opens with a gap up and forms a medium-sized bullish candle. The pattern receives this name because the position of the third candle resembles the shape of a tower. Notice that there is a story that goes along with the pattern, which is that sellers were advancing price to the downside and then started to deaccelerate. After that, a sudden burst of buying pressure appeared, and sellers tried to overcome that. The fact that sellers failed to fully overcome the buying pressure opens the door for the buying pressure to rise and create the bullish reversal pattern. The tower bottom appears when price is going down in order to signal a reversal to the upside. The final complex reversal pattern we are going to see is the tower top, which is the mirror image of the tower bottom, so it's a bearish reversal pattern. The first 2 candles in the pattern are bullish, 1 medium-sized candle followed by a small candle. That already denotes a decrease in buying pressure given the decrease in the body size of the second bullish candle. The third candle in the pattern is a small bearish candle that opens with a gap down. That means a sudden burst of selling pressure. The fourth candle in the pattern is equal to the second candle in the pattern, and it opens with a small gap up. The important thing here is that a sudden burst of selling pressure appeared, and then the buyers tried to overcome that, but failed to do so because the fourth candlestick in the pattern fails to advance price to the upside any more than the second candle did. The last candle hits the final nail in the coffin, so to speak, because it opens with a gap down and forms a medium-sized bearish candle. Observe that there is a story that goes along with the pattern, which is that buyers were advancing price to the upside and then started to deaccelerate. After that, a sudden burst of selling pressure appeared, and buyers tried to overcome that. The fact that buyers failed to fully overcome the selling pressure opens the door for the selling pressure to increase and create the bearish reversal pattern. The tower top appears when price is going up in order to signal a reversal to the downside. We want to move on now to the continuation patterns. In other words, the candlestick patterns that imply that price will continue to go in its current direction. A couple of things to notice here before we dive into the patterns is that there aren't as many continuation patterns as there are reversal patterns, and there aren't simple continuation patterns. We'll start with the complex continuation patterns formed by two candles. The first complex continuation pattern we are going to study is the bullish separating line, which is formed by one medium-sized bearish candle followed by one medium-sized bullish candle that opens with a gap as big as the body of the first bearish candle. The logical interpretation here is very simple. Since the second candle opens with a large gap up and it creates a medium-sized bullish candle, it becomes clear that there is a considerable amount of buying pressure implied in this pattern. The bullish separating line appears when price is going up in order to signal a continuation to the upside. Next, we have the bearish separating line, which is the mirror image of the bullish separating line, so it's a bearish continuation pattern. The pattern is formed by a medium-sized bullish candle followed by a medium-sized bearish candle that opens with a gap as large as the body of the first candle. The fact that price opens in the second candle with a large gap down, added to the fact that the second candle has a bearish quality, implies that there is a lot of selling pressure in the market. The bearish separating line will appear when price is going down in order to signal a continuation to the downside. The next pattern is the bullish on-neck line, which is also composed by two candles. The first is a medium-sized bullish candle. The second is a small bearish candle that opens with a considerable gap up. The logical interpretation here is that the fact that the second candle opened with a gap up and was unable to close this gap implies that there is a lot of buying pressure in the market and sellers are not strong enough to fill the gap, which implies that price will continue to go up. The bullish on-neck line appears when price is going up in order to signal a continuation to the upside. Next, we have the bearish on-neck line, which is the mirror image of the bullish on-neck line, so it's a bearish continuation pattern composed by two candles in the formation. The first candle is a medium-sized bearish candle, and the second is a small bullish candle that opens with a considerable gap down. The fact that the second candle opened with a gap down and was unable to fill that gap implies a strong selling pressure in the market, and therefore price tends to continue going down. The bearish on-neck line appears when the price is going down in order to signal a continuation to the downside. This covers the complex continuation patterns formed by two candles. Next, we are going to study the complex continuation patterns formed by three candlesticks. The first complex continuation pattern formed by three candlesticks is called upside Tesuki gap, which is a bullish continuation pattern similar to the bullish on-neck line, but with a few extra details. The first candlestick in the pattern is a medium-sized bullish candle. The second candle in the pattern is a small bullish candle that opens with a gap up, and the third candle is a small bearish candle that fails to close the gap created between the first and second candlesticks in the pattern. It's clear that there is a lot of buying pressure between the first and second candlesticks. The third candle in the pattern adds more confirmation to the buying pressure because it fails to close the gap created by the first two candles in the pattern. In fact, it doesn't even attempt to close the gap. The bullish Tasuki gap appears when price is going up in order to signal a continuation to the upside. Next, we have the downside Tasuki gap, which is the mirror image of the upside Tasuki gap. So it's a complex bearish continuation pattern. The first candle is a medium-sized bearish candle. The second is a small bearish candle that opens with a gap down. And the third is a small bullish candle that fails to even attempt closing the gap created between the first and second candlesticks in the pattern. It's clear that such a pattern implies a lot of selling pressure because of this failure to close the gap down. The downside Tasuki gap appears when the price is going down in order to signal a continuation to the downside. Next, we are going to see the complex continuation patterns formed by 4 candlesticks in the pattern. The first one is called bullish 3-line strike, which is formed by 3 consecutive small to medium-sized bullish candlesticks, followed by one large bearish candlestick that closes more or less where the first candle in the pattern opened. The logic behind this pattern relates to the idea of quick exhaustion of selling pressure. Notice that price rises slowly and then all the selling pressure that was also building up is exhausted all at once. This opens headroom for buying pressure to continue. This can seem a little counterintuitive at first because of the size of the bearish candle and the fact that this is a bullish continuation, but the key is to understand this concept of quick exhaustion of selling pressure in this particular case. The bullish 3-line strike happens when the price is going up in order to signal a continuation to the upside. Next, we have the bearish 3-line strike, which is the mirror image of the bullish 3-line strike. So it's a bearish continuation pattern. The pattern is formed by 3 small to medium-sized bearish candles, followed by a large bullish candle that closes more or less where the first candlestick in the pattern opened. The idea is the same as in the bullish 3-line strike, but this time we are dealing with the quick exhaustion of buying pressure that builds up in the background as price slowly falls. When the buying pressure finally exhausts itself in the large bullish candle, sellers have the freedom to continue on their way down. The bearish 3-line strike appears when price is going down in order to signal a continuation to the downside. Next, we have the final 4 candlestick patterns that are formed by 5 candles. The first pattern is called Rising 3 Methods, which is a bullish continuation pattern formed by one medium-sized bullish candle, followed by 3 small bearish candles, given that the third bearish candle closes where the first bullish candle opened. The last candlestick in the pattern is formed by a medium-sized bullish candle like the first candlestick in the pattern. The name of the pattern is a little confusing because the term rising refers to the direction that the pattern implies, not the candles themselves. And the third methods refers to the 3 candles in the middle. It's a bit confusing because the name says rising 3 methods, while the 3 bearish candles fall. The logic of this pattern is that the 3 bearish candles in the middle represent a temporary break in the buying pressure exhaustion, meaning that sellers assume control until price reaches the last level where buyers displayed high intent, which is the open of the first candlestick in the pattern. The 5th candle in the pattern resumes the original intent of buyers. The rising 3 methods appear when price is going up in order to signal a continuation to the upside. We also have the falling 3 methods, which is the mirror image of the rising 3 methods pattern. So it's a complex bearish continuation pattern formed by 2 medium-sized bearish candlesticks in the extremes and 3 small bullish candles in the middle. The interpretation is the same as in the rising 3 methods, but this time the sellers temporarily hold the exhaustion of their intent and let the buyers create 3 small candles up until the level where sellers began showing their intent in the first place. The pattern is complete when sellers resume the exhaustion of their energy with a medium-sized bearish candle. The following three methods appear when price is going down in order to signal a continuation to the downside. The next pattern is called bullish mat hold, and it's similar to the rising three methods, but this time there is a higher degree of buying pressure that doesn't allow the three bearish candlesticks in the middle to go back to the original place of intent of buyers. In other words, buyers begin to pick the market at a higher level than in the rising three methods pattern, and that implies more buying pressure. The bullish mat hold appears when price is going up in order to signal a continuation to the upside. The final continuation pattern is the bearish mat hold, which is the mirror image of the bullish mat hold. The interpretation follows the same rationale, but in the opposite direction. In other words, sellers stop the exhaustion of their selling pressure to let buyers breathe a little bit, but not enough to rise the market up until the original place of intent of sellers. This implies a strong selling pressure. Notice that in the following three methods, sellers let buyers rise more than in the bearish mat hold. The bearish mat hold appears when price is going down in order to signal a continuation to the downside. This finishes the presentation of the candlestick patterns that I find to be more relevant. If you do some research, you will find more patterns, but in my opinion, these are the ones that are more reliable, roughly speaking. Let's now move on to talking about the advantages and disadvantages of this technique. Then we'll move on to the course conclusion. At this point, we want to understand the advantages and disadvantages of using candlestick patterns in trading. We'll start with the advantages because it's a smaller list, and then we'll focus on the disadvantages of the technique. This is the most critical point of this course because we need to be as unbiased as possible regarding any trading technique. That means truly accepting its strong and weak points. The most obvious advantage of using candlestick patterns is the simplicity of interpretation that each pattern brings. In other words, it's very easy to understand what each pattern means and the internal logic of each pattern. That's clearly an advantage because most people are always after a simplistic solution in trading. However, the simplicity comes at a cost, as we'll see in a moment. The other advantage is that candlestick patterns are a type of price action analysis, which tends to have a lot less lag than technical indicators, for example. These are the two advantages of the candlestick patterns technique. Now we want to focus on the part that really matters, which is the bad side of the technique. I say that is the part that matters because without apprehending the flaws of this way of trading, you will not be able to move forward and understand more advanced ideas that are necessary in order to achieve any level of consistency in trading. The most evident disadvantage is that there are too many candlestick patterns to be memorized, and that's clearly a problem in trading. That's the case because candlestick patterns are just one technique, and one technique alone is not enough to produce good results. In other words, beyond the memorization and understanding of dozens of candlestick patterns, the trader also needs to memorize, understand, and master a wide array of other tools. All of this knowledge will be tested against the clock in real-time trading. In other words, even though candlestick patterns are valid, they are a suboptimal solution because they are not cost-effective. In other words, the trader needs to memorize an enormous amount of shapes and interpretations just to apply one single technique. Another disadvantage is that even though there are dozens of candlestick patterns, they don't fully exhaust all the possibilities of how candlesticks appear in the chart. In other words, candlestick patterns are counterproductive in two different ways. There are too many patterns to memorize, and they don't explain everything that candlesticks can do. So even if you study the patterns a lot and memorize them, you'll still be missing other possibilities of interpretation using candlestick charts. A third disadvantage is that candlestick patterns tend to focus on memorization of patterns instead of the logical understanding of what candlesticks are doing. Even though I made sure to include the logical interpretation of each pattern in this course, that's not how most people use these patterns. Most traders simply memorize the shape of the pattern and the direction that the pattern implies for the market. The issue with that is that there are situations where the same candlestick can mean two different things, depending on the larger context of the market, which leads me to the fourth disadvantage. The fourth disadvantage is that since candlestick patterns are a sort of prepackaged solution for a trader to quickly identify what's going on, they tend to ignore the overall context in which candlesticks appear, and that can generate wrong signals and flaws of interpretation, which is precisely what traders want to avoid. Another big disadvantage of candlestick patterns is that the shape of candlesticks can vary a lot and still fall within the guidelines of each pattern. In other words, in real charts, the candlestick patterns will rarely appear in the textbook formation. Sometimes they will display a larger upper or lower tail, gaps where the original pattern doesn't presume any gaps, candle bodies of varying sizes, and so on. This makes it more difficult to use these prepackaged interpretations in real charts and in real time. Given these advantages and disadvantages, there are a few conclusions we can achieve about the use of candlestick patterns in trading. Instead of memorizing a bunch of candlestick patterns with many different names, we want to understand how candlesticks work in a more abstract way, which is the relationship between the body and tails of the candlestick, the position of each candlestick in relation to surrounding candles, and the overall context of the market in which they appear. By doing that, we solve all the 5 problems of candlestick patterns that I listed in the previous slide. That is a more cost-effective way of using candlesticks, and it's actually a lot easier than memorizing several shapes and names. That by itself will dramatically increase your understanding of price action in general, and you will be able to quickly analyze any candlestick in any situation just by looking at it without memorizing a huge list of names and patterns. Notice that this is a difficult thing to understand if you don't grasp the gist of how candlestick patterns work first. In other words, you cannot learn how to avoid them without understanding their flaws first, and you cannot understand their flaws without understanding how they work in the first place. One of the pernicious things about these common techniques of trading is that it's easy to understand how they work in general, but their problems are difficult and non-obvious.